Let's get straight to our senior economics correspondent, Steve Liesman, who is in Atlanta, where he attended the Fed panel earlier today. Hi, Steve.
Hey, Melissa, when you said those words, patient and flexible, I thought of like a running back and a gymnast. That's what they think Powell is now, I guess. Let's get to some of the key takeaways that Powell said today here in Atlanta. 1, flexible on rates. 2, inflation is muted, which allows him to be flexible on rates. 3, the balance sheet is up for discussion in a way that he hasn't perhaps said before. And as Melissa said very correctly there, maybe the most important thing was he said the Fed can be patient.
With the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy and to shift it significantly if necessary in order to promote our statutory goals of maximum employment and stable prices.
Of course, interesting to hear a dovish Fed chairman on a day when jobs were 312,000, almost double the expectation. Let's take one more look at those jobs reports because we can and we should. Very strong numbers, especially those revisions. Plus 58,000. Unemployment went up for all the right reasons because people came back into the workforce. And I want to show you this comment just because you think you may be out of the woods here around the table there. Look at what Oxford Economics is saying about rate hikes. The very strong labor market pictures support our expectations that the Fed will keep a tightening bias in 2019 and hike rates twice next year. So, guys, I don't know if Powell was telling the markets what it wanted here for the current situation, but I do think if these strong data continue, we may be back talking about something else, not rate cuts next year, but maybe rate hikes or this year.
Hiking twice this year, right? That's because Oxford Economics said next year. They meant this year.
I'm so sorry.
No,
I guess that's a mistake he made in his. Exactly.
I mean, we just,
yes,
I mean, it's still New Year, where you get confused. But, what was interesting, Steve, is that, I listened to the panel. I didn't actually watch the panel, so I didn't realize that Powell was actually reading off a statement reading off a piece of paper when he said those words. It's almost as if he wrote this statement to come to where the markets are. He did this very, very carefully.
And deliberately. I think you're right, Melissa. I think that maybe the chairman has been a little bit off the cuff, a little extemporaneous, a little ad lib, ad hoc, pick your words there, when it comes to speaking to the markets. You remember that the comment he made that was so controversial, the one about the Fed being a long way from neutral, was made when he was speaking to essentially a lay audience, not to markets. And I think that Powell may have learned his lesson here, maybe speaking with a little more precision. Now, it's funny, on the balance sheet, for example, kind of met the market halfway here. He said, look, we don't think it's a problem now, but if we do think it's a problem, then we would not hesitate to change it. Previously, in other statements, remember he said it's on autopilot back in December, and then the Fed's own policy statement, the FOMC, says that they're not really going to alter the balance sheet unless they begin to cut rates sizably. So that is a change and an important change, but only if they judge that the balance sheet runoff as it stands now is a problem.
It's funny. I don't think that Powell met the markets in the middle. It seems like Powell went all the way to where the markets were. I mean, effectively putting everything on the table, saying that everything is data dependent effectively. They're willing to change their policy stance as conditions warrant. That's data dependent on balance sheet and rates. I mean, that's what it sounds like to me.
Right, but see, I always thought, Melissa, and I guess it depends on where you think the Fed was and what you heard the Fed say previously. I always thought rate hikes were data dependent. Before that, the Fed was not saying the balance sheet was. So that's when I say sort of halfway. They didn't really change, in my opinion, on the rates part, but it looks like they are about to change. And by the way, we're going to need to listen to the committee, whether or not the committee agrees with this new idea that the balance sheet is up for discussion here.
All right, Steve, thank you very much. Steve Liesman, Atlanta, for us. So the question is now, is the Powell put back in the market? Is this the all-clear signal to buy stocks once again? Guy.
Yeah, I don't think so. I mean, I didn't think the market was going up.
Which question? Both questions?
I don't think it's the all-clear sign, and I don't think the Fed put is back in place. My opinion. I didn't think the S&P was going up 85 handles today. We alluded to the fact that, given the market turmoil, maybe President Trump would make some comment about the renewed interest in doing a deal with China. You sort of got that. That was probably 20% of this rally. But to your point, I think the Fed was speaking with the language that the market wanted to hear. Now, it's interesting you talk about autopilot. I mean, sometimes, every plane you get on, the guys and gals in the cockpit, they flip on autopilot and they hang out. Sometimes there's a little turbulence. They got to get the controls. But they put the autopilot back on, and I think that's going to be exactly what happens with this Fed. I do think they're on autopilot in terms of reducing the balance sheet, and I think they should be. In terms of the rates,
I want you to know we're all counting on you.
You see, Tim got that. It's right there. I appreciate that.
So look, to me, today I watched the Fed, I watched the market reaction, and it's impossible for me to believe that this Fed is any different today than they were 2 weeks ago. I totally agree with my friend Guy.
They're sending a very different message.
Well, they're talking about the balance sheet, and the word flexible is very important. But if you think that the Fed put is back in play and suddenly it's central bank mania all over again, you're going to get crushed. Because the bottom line here is the market needs to understand, first of all...
What do you understand as a Fed put, just before we proceed with this conversation, because I think that's an important part. I mean, is the Fed put the notion that the Fed is watching the markets, the Fed is watching economic conditions, and will change its stance according to those conditions, or is the Fed put easy monetary policy?
Great question to clarify. The Fed put to me is a Fed that is market responsive and market duress, and will jump in there independent of a call they are making on the economy, which is a call that's based largely on a couple things, including labor. And we're at the highest labor wage gains we've had in over a decade. So since the crisis, it's never been hotter than it is right now. And I realize that the labor market is maybe coincident at best, and it could be lagging, and it doesn't tell you about tomorrow. But this is what the Fed looks at. So to me, everybody that thinks that 2 weeks ago Powell didn't give them what they wanted and they freaked out, I think are the same people that freaked out today. And I think it's somewhere in the middle. I really do.
I mean, to me, I think he gave a very different message today.
I think so, too.
The Fed, the balance sheet was off the table 2 weeks ago. I think it was pretty clear then. The balance sheet was off the table. I don't think that's the case anymore. However, I wonder how bad does it need to get before they actually stop QT, right? Might be pretty bad. So this is not an at-the-money put, right? We would need some downside before that put would kick in. So, I mean, just this action today, though, I mean, they had a lot of things go right. I guess big, maybe oversold conditions. But then also you had the data out this morning. That was really good. But to have this two-day action, to have the market essentially be flat, I hate that kind of market. I absolutely hate that kind of market. I think it's a much riskier market. And I'd rather that normally I love to buy when things are really down a lot. But in this kind of market, I certainly wouldn't want to buy on a day like today. That's scary to me. To me, still, though, the number one issue is trade.
Yeah, so the price action over the last few days, I think it's disastrous for the bulls. And I'm not saying that we're going to see a meaningful sell-off or correction anytime soon from these points. I think that, you want to have, the buying today was panic. And if you think about the last few weeks, you might have said that from December 17th to the lows right around Christmas or something like that, that was panic selling. But when you think about most of 2018, when we had sell-offs that were fairly orderly, you just don't like to see this sort of panic buying. It's not sustainable, right? So at the end of the day, we know that the earnings are going to be the most important thing for at least our stock market in the near term. Obviously, there's nothing that we're going to get on trade. I agree. There's a good conversation about the Fed. It is a little different from October 3rd. It's different than from a few weeks ago, but it's just marginally different. The fact that he showed up with some prepared remarks, they realize that they want to be, a little tighter on their messaging, and I think the tighter that they get, the better it's going to be. But that being said, we talked about this last night, with the 10-year going the way it has gone with equities over the last few weeks, is just showing you how fragile the recovery is and showing you how fragile the stock market is. And a dovish Fed at this point just tells you that they're just not that confident even when they see the jobs data that's part of their dual mandate this morning. David Rosenberg of Gluskin Sheff, I know a lot of people think he's this perma bear. He's been highlighting over the last few weeks that the job gains that we have been seeing are such low quality this late in the cycle. It's just not good. And it is backward looking, especially when you're gaining these multiple job workers and all. It's just not good.
But the Fed can take some cover, though, with inflation, right? There is no sign of inflation getting out of control here. Yeah. So given that that's half their dual mandate, that gives them a lot of flexibility.
And I'm not sure which is the tail or which is the dog, but let's be clear. Lower energy prices are certainly pushing deflationary forces, at least on the headline inflation, maybe not at the core. The European, essentially the Eurozone, printed a minus 0.4 on their PPI this morning. And again, I realize that there's a lot of volatility in these numbers, but the good news for the market is that look, for the better part of the last decade, we've been waiting for inflation to appear. And on some level, we would like that. To be clear, I'd much rather have an inflation scare than a growth scare, and the markets would as well. So we want to see some inflation here, folks. And actually, on some level, you really want the Fed to be front-footed, not back-footed. But what you want is the Fed not to overreact. And so if today gets the market to a place where I think they were certainly psychologically of the view that this Fed was going to be robotic and autopilot and whatever you want to call it, and not thoughtful and not truly data dependent, then that's an important part of what happened today.
I think the other acknowledgement that came across clearly today was that Powell said that he monitored the markets. The markets were actually a real input in this whole thing.
You're right. No, he said
because as we enter warning season, and we got it with Apple, as we enter earnings season, you want to know, right, that they're looking at these conference calls, they're talking to people, they're listening to what the markets are saying. At least that they hear it. It is part of the data of being data dependent.
I agree. And my pushback would be we've conditioned corporate America, Dan might disagree with me, over the last 8 or 9 years. They're so used to rates being where they are that any glitch, I shouldn't use the word, any move in rates, they can't cope. I mean, you have to get a point where...
It may not be rates, though. It may be China. Well, I mean, what was Apple? Apple wasn't rates.
So it's funny that you mentioned, though, that corporates can't deal with the rate increases. You know, the talk about this corporate debt bomb, the refinancing over $1 trillion in corporate debt next year, we haven't even gotten to see how corporates can deal with that because they've had this huge borrowing binge because rates have been so low. They've been buying back their own stock, and I think that's part of what's going on here. We haven't even seen that yet. That's coming in 2009.
And that's the lazy part. You know, when money's cheap and all you do instead of focusing on your business and trying to, have a 5-year plan, you're just buying back stock and increasing your dividend. That's not doing anybody any good. It might be great for the stock market, but you've made, in my opinion, one of the many unintended consequences of the past Fed is made corporate America lazy.
And funnily enough, I mean, Apple really encapsulates both these problems, right? The laziness of corporate financial engineering, buying back stock. I mean, what they spent. How much? $63 billion last year buying back.
Or the criticism of
Apple. It does not leave them in a levered situation.
Not at all. But they could have invested elsewhere.
They had enough to do both.
China.
They had enough to do both.
They could have.
They did, and they could have. Right. They have enough to do both. But one guy makes one very interesting point often.
Only.
Yeah.
Sorry.
Rarely, but often.
Yeah. You want to hear what it is? Are you excited?
I'd love to.
The point is
enough to know that it was a good point.
Does markets cause a recession, or does a recession cause markets to sell off? And so, to the extent that the Fed is looking at markets, how they react, maybe they believe there is some element of markets causing a recession. I believe there's something to that. CEOs are human. They get scared. They sort of want to pull back
spending. Yeah.
They want to pull back spending.